Hello everyone, hope you're well, and today we're going to be talking about margin orders, leverage, and liquidation, but we're going to start off by clarifying what market orders and limit orders are. So a market order, I'm going to write this down. When you place a market order, you don't even get to choose the price at which you are selling or buying a coin. So let's look at an example here. Let's say that Bitcoin is trading at $8,000 and you place a market order to buy one Bitcoin. This does not mean that you will buy one Bitcoin at $8,000, okay? It does not mean that at all. As you will see in the next video, you have what we call an order book. And an order book is a list of orders already placed in the market. And if you place a market order to say buy one Bitcoin, what the exchange will do is it will instantly match your order to buy with orders to sell. Therefore, your order will be filled instantly, but it will also come at a cost because you will pay a fee. You'll pay what we call a taker fee. The same goes for the sell side. So say you're selling one Bitcoin at $8,000. If you place a market order to sell at $8,000, you have no guarantee it will be at $8,000. It could be at $7,995, $7,992, and on top of that, you will pay a fee as well. Stay away from market orders because if you take market orders, you will be paying fees that you would otherwise not be paying if you're placing a limit order, and you are not guaranteed to get the price that you place the market order to sell or buy at, okay? Now, for me, I am constantly executing market orders on Bitfinex because I am what we call a market maker because I produce over $50 million worth of volume for Bitfinex. Therefore, I pay a very, very little fee to execute a market order. If you're not on the same spot as I am, I highly recommend against doing this because you're paying fees that you would otherwise not pay with a limit order, as you'll see next. So, what are limit orders? I'm, as always, going to write stuff down. A limit order is the maximum amount you are willing to pay or receive for a coin. So say you want to place a limit order on Bitcoin, right? Bitcoin is now trading at 6,397, and say you want to place a limit order to buy Bitcoin at 6,395. So what does this mean? This means that you are willing to buy one Bitcoin at a maximum price of 6,395 and not higher. Meaning that you will buy Bitcoin at any price if it's 6,395 or lower, all right? If you place a limit order to sell one Bitcoin at $7,000, that means that you are willing to sell one Bitcoin for the bare minimum price of $7,000, but not lower. So let's go over this one more time to make sure we are clear. So if you're on the buy side of limit orders and you place a limit order to buy one Bitcoin at 6,395, what this means is that you are willing to buy one Bitcoin at 6,395 or lower but not higher. So let me actually add that here. 6,395 or lower but not higher. All right? So if you place a limit order to buy one BTC at this price, you can rest assured it will be filled at this price or under, but never higher. All right? So let's go over here to the sell side. So if you place a limit order to sell one BTC at 7,000, you are willing to sell one BTC for 7,000 or higher, but not lower. Which means you can rest assured that if your order to sell one BTC at 7,000 is filled, you are going to sell that one Bitcoin for 7,000 or higher, and you're guaranteed to never sell lower. Okay? Alright, so now that we have that out of the way, let's go over margin orders, which can be a little tricky, but I've been told I am pretty decent at explaining somewhat difficult, trickier topics, so let's hope this is a breeze for you. So let's go over what margin orders are. Alright, so as always, I'm going to write this down, and this one you really should screenshot because it's going to be quite an elaborate one. Alright, so before we go over what margin trading is, we must first go over funding, because for an exchange to allow margin orders, they must first allow funding. Let's first define what this is and how we can use it. So funding is offered by an exchange, and users can deposit Bitcoin or EOS or US dollars to their funding account on an exchange, and your funds are 100% safe, and you will get interest for the amount of days that you are funding. So let's put this down here as well. Users they deposit on their funding account their crypto or fiat, and the exchange will in turn pay the user interest. Alright, because your money is 100% guaranteed to be safe, your interest is obviously very low. It's still a lot better than a bank, right? But it's still very low. So now comes margin trading. Alright, let's put this here. So margin traders will then use funds in the funding account to trade with. They will trade with funding money, which is money that the users provided the exchange to the funding account, and in turn, they will pay the exchange interest. So let's go over this again. You have the regular user who deposits cryptocurrency or fiat into an exchange's funding account. The funds are 100% guaranteed to be safe. Then the exchange will lend the money to margin traders. The margin traders will then pay interest to the exchange for using that money that wasn't theirs. The exchange will then pay a portion of that interest to the user who was lending the money. So now that that's clear, let's go over what margin trading is, all right? So there are two types of positions in margin trading. And you must have heard about both of them, if anything, just from me. One will be called long position, and the second one will be called short position. As you recall from just here, in order for an exchange to offer margin trading, it must also offer funding. And why is that? That's because when you buy, say, Bitcoin on margin, you don't actually own that Bitcoin. You are simply buying Bitcoin using money that another user lent to you in hopes that Bitcoin goes up, so you can sell that Bitcoin at a higher price, give the lender the original money you borrowed, and you get to keep the difference. I know this is confusing at first, so we're going to write this down. When you buy Bitcoin on margin, you don't actually own that Bitcoin. You are simply buying Bitcoin using money that another user lent to you in hopes that Bitcoin goes up, so you can sell that Bitcoin at a higher price. Give the lender the original money, and you get to keep the difference. So for the example, we're going to come here to Bitcoin on a 4-hour chart, okay? And don't worry, don't be scared. By the time I finish these examples, you'll completely understand margin trading, all right? Let's use this example right here. As you can see, Bitcoin here is trading at 6,800. Let's use round numbers because it makes the explanation a lot easier to understand. At this level here, Bitcoin was trading at 6,800. So let's annotate that down. It was 6,800. Trader goes long. All right? So a trader opens a long position here at 6,800. So what actually goes down behind the scenes is the trader just borrowed $6,800 from the funding account of the exchange, money that was not his, bought one Bitcoin at 6,800, right? So then he rides that long, and right here at 7,300, he closes the long. So let's write that down. 7,300, trader closes long. What actually went down behind the scenes when he closed that long is he sold the Bitcoin. He sold the Bitcoin at 7,300, paid back the lender 6,800, and got to keep the difference. Let's write the whole process down using this example that we just mentioned here. Trader opens long at 6,800. Okay? So what does this mean? This means trader borrowed 6,800 and purchased one BTC. BTC climbs to 7,300. Trader closes long. What this means is trader sold BTC at 7,300, paid back the 6,800 he just borrowed, and got to keep the difference. $500. Okay? I'm just showing you what happens behind the scenes, because really all you see is you open the long here and you close the long there. All right? But this is what actually happens behind the scenes in the exchange. All right? So now let's go over short positions. Okay, don't be alarmed if you don't get it right away. Much like the long position, I'm sure that when we go over to the examples, it will be a lot clearer for you. So let's write down what shorting is. When you short one BTC, you are actually borrowing one Bitcoin from the funding account, sell it at the current price, hoping that the price goes down so that you can rebuy that same amount of Bitcoin, return the Bitcoin to the lender, and you get to keep the difference. Okay? So now let's go over a few examples. So we're back at the Bitcoin 4-hour chart. In here, we use the example to showcase what a long position is. So we're going to use this downtrend conveniently located right next to the uptrend so that we can showcase a shorting example, all right? Let's assume that a trader enters a short position here. Bitcoin is at $7,400, all right? So let's write this down like we did before. 7,400, trader enters or goes short, right? We're back here. Let's say right here at 6,600, all right? 6,600, trader closes short, all right? At 7,400, the trader borrowed one Bitcoin from the funding, right? Because recall, when a user sends funds into the funding account, it could be any type of funds. It could be any type of cryptocurrencies or any type of fiat, right? So because we're margin trading Bitcoin and we went short, that means the trader borrowed one Bitcoin here at 7,400, immediately sold the Bitcoin. The price went down to 6,600. So now what the trader does is he buys back the Bitcoin here at 6,600 and gives that one Bitcoin to the lender plus interest, right? Recall, this is always has interest involved, although it is very, very little. It's almost non-existent. So he gives back the one Bitcoin plus interest to the lender and gets to keep the difference. So he borrows at 7,400, sells the Bitcoin at 7,400, Bitcoin drops to 6,600. He rebuys that same Bitcoin that he sold here for $800 cheaper, gives that Bitcoin back to the lender, and gets to keep the difference. A simple way of looking at this, not even looking at the chart at all. It's just thinking a trader goes and borrows a Bitcoin and sells it, right? The price goes lower, so then he buys back that same Bitcoin and gives back to the lender. He gets to keep the difference, right? So let's gonna write this down so you have a clear image of what this is. So trader opens short at 7,400. What this means is trader borrowed 1 BTC and sells it for 7,400. Okay? BTC drops to 6,600. Trader closes short, which means trader rebuys 1 Bitcoin at 6,600, gives that 1 Bitcoin back to the lender, and gets to keep the difference, which in our case is $800. Okay? Alright, so before we move on to leverage, I want to bring to your attention short squeeze and long squeeze. You must have heard about that quite a lot, and if you've been following me, this is no news to you, and I will be using an example that I posted on Instagram, which was a textbook short squeeze. It happened right here. This is a 4-hour Bitcoin chart. It happened right here. That's a short squeeze. This is a complete textbook short squeeze. Let me tell you why. A lot of people were not expecting 6,800 to be breached because it acted as clear resistance all throughout the month, right? We tried here, there, here, and here as well. So it never crossed, right? So a lot of people that were shorting here were also placing stop losses, or in this case, buybacks around here. So why am I saying buybacks? Because recall, shorting, you don't actually own Bitcoin. You were borrowing Bitcoin, selling it, hoping to buy back lower, return to the investor or to the lender in this case, and keep the difference. When you're closing your short position, you're actually buying back Bitcoin, which is important to analyze price action. So because there were a lot of stop losses for people's shorts here, so they opened shorts right around here, and all their stop losses were at 68.50, 69, even 7K, even 7.1 or 2, right? And if the price gets to that level, they will be liquidated or their stop loss will trigger, which in any case, they will be forced to buy back that Bitcoin, causing an explosive price up. This is called a short squeeze because there were so many shorts here at this level building up crazy amounts. It created fuel for the bulls to push the price only a little bit higher, because you have to think about it this way. Look, if they push the price to 68.50, all the stop losses at 68.50 will be triggered, causing the users to buy back Bitcoin at this level, causing the price to move higher. At 69.50, they likely caused other people's stop losses to be triggered, and they too were forced to buy back, causing this over and over again until we reach this level, right? The same happened here. 7,800 was another crucial resistance, right? Right here. So a lot of people were placing shorts at this level with stop losses here, 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 etc. So the bulls knew once again that if they managed to push the price just slightly higher, the short squeeze would do the rest. Everyone would be forced to be buying back Bitcoin, and this would cause the price to go higher and higher. So what we saw here, along with some FOMO, was mere short squeeze action, okay? And this is said equally well for long squeeze. So if you come over here, you can see, for example, here, that because 6,800 were such strong resistance here, it became strong support here. So a lot of people here were placing longs with stop losses at this level here, right? So the bears know this, so what they did was they did long squeezes, meaning that they knew if they could push the price just slightly below this, it would cascade down because all the people going long were forced to close their position, therefore selling, which caused the cascade effect to tumble where we are now. And let me show you, before I move on to leverage, how you can see the shorts and longs in place. So if you go over here, you can actually type down BTC USD longs, and there you have it. Those are the longs on Bitfinex. So if you go on a daily chart to get a better visual, these are the longs placed on Bitfinex. So here you have 28,000 right now as we speak, 28,000 Bitcoin worth of longs. And then same thing, you can just come here, type in BTC USD shorts, and it will give you the shorts on Bitfinex. So now you have 26,654 BTC worth of shorts. All right, and you should always have these saved in your tab over here, like I do. As you can see over here, I have both, and you should have them always because it's a very accurate representation of what's going on in the market. All right, so now let's move on to leverage. So in very simple terms, leverage is using money that you don't have. All right, so when you have money in your margin account on an exchange, you're leveraging that money to get more money. So as many of you know, I trade almost exclusively on Bitfinex. Specifically on Bitfinex, they allow 3.3x margin trading. That means if you have $100 on your margin account, you can trade 3.3 times that, all right? So you can actually trade more than $100. And depending on which exchange, this maximum level will change. So Bitfinex only allows 3.3x margin trading, which is considered conservative. It's nothing too much, but it's all I need personally. So this is for Bitfinex. On the other end of the spectrum is BitMEX, as many of you may have heard. Mostly because BitMEX allows something that is, for lack of a better word, ridiculous, which is 100x leverage trading. Because they allow this, you can put in $100 on BitMEX and you have $10,000 to trade with. So if you put $100 on your margin account, you can trade with $10,000. Using such an obscene amount of leverage is nothing short of idiotic, right? There's no need ever to use this amount of leverage. You're only putting your account at risk. Remember, you're borrowing money, and the person you're borrowing from, which you'll never know, it's all in the exchange in the back end, but who you're borrowing from is guaranteed 100% of getting their money back. If you can't afford to pay this, they will liquidate your account. I would say out of 10 trades, I use a conservative amount of leverage on about 1 or maximum 2 of them. There's absolutely no need, it's not a requirement for you to be successful on any market to use high leverage. You have to see this as a double-edged sword, right? Because yes, you can win big, but you can lose very big as well. I'm not here saying leverage trading is something that you shouldn't do, but personally, if you care about my personal example, I rarely trade with leverage. I would say out of 10 trades, I use a conservative amount of leverage on about 1 or maximum 2 of them. There's absolutely no need, it's not a requirement for you to be successful on any market to use high leverage. When you use leverage, the percentage given to you by the exchange as your profit and loss, that's not your percentage gain on your leverage position. It's on your initial position without leverage, okay? So let's say you put in a $20 position at 100x leverage. That means you're at a $2,000 position. But the return that the exchange will give you, your profit and loss, say 5, 10, 20, even 100%, that's on your initial investment, which was $20, not $2,000. Let's take a look at a few examples, okay? I'm going to write these all down. All right, so you went to short, right? If the price drops 5%, you just made 50%. If the price drops 10%, you just made 100%. Now, you must also see that if the price jumps 5%, you just lost 50%. If the price jumps 10%, you just lost everything. Okay? So if you change this here to a long, the only thing that will change is if the price, so here you have to change this to jumps and these to drops. Okay? Now these numbers are not going to be accurate because you need to take into account taker fee, all right? So these will likely be somewhere around here. these are more accurate to what is actually going to happen because you have to take in the fees of trading in BitMEX, all right? So I'm going to wrap up this video by saying, if you're going to go on BitMEX, definitely start off with the testnet. Practice around there for a week or two until you jump in with real money and actually trading with leverage, okay? I personally rarely, if not never, use anything above 10 leverage, okay? There's absolutely no need to do that to be successful. The vast majority of my trades, it's under 3.3x leverage because the vast majority of my trades are on Bitfinex. So in the next video, I'll be showing you limit orders, margin orders, leverage, liquidation, and how to get around Bitfinex and BitMEX. All right, so I'll see you in the next video.